Hello viewers, welcome to my channel. I'm Hasham. So now in this video, I'm going to start a new topic called irrecoverable debts. Last videos I have prepared on trial balance for the IGCSE students. So in this video, I'm going to completely explain the concept of irrecoverable debt. The next video we'll solve the problems on irrecoverable debt. So if you want the complete perfection on the topic, watch the video till the end. Don't skip in between. Definitely you can be able to get a lot of knowledge from these videos. So keep watching. So before explaining the concept of irrecoverable debt, I expect my viewers to take a screenshot of the notes which I have written on the board. After that, I'll explain each and every point about irrecoverable debt. May sell the goods on cash as well as on credit. When the goods are sold for cash, immediately the customer will pay the cash. The account will be settled. So business will not maintain the account of the customer because customer has already paid the cash. But nowadays goods are being sold on credit also. No business will depend only on cash sale. The business will also sell the goods on credit. What do you mean by credit sales? The goods are sold right now, but the customer will pay the amount after a period of time. Like after 2 months, after 1 month, after 3 months, like that. A credit period is allowed. So in a particular business, so many credit customers are there from whom amount is owed to the business. We are having a business, we have to receive the amount from so many credit customers. But it may happen that some of the customers may not pay the amount. So when the customer will not pay the amount, the business will write off that debt from that customer. So the debt which is irrecoverable, not recoverable from the customer, is called irrecoverable debt. Simple words, irrecoverable debt is a debt which is due from credit customer, but it is not recoverable. When the business thinks that amount we cannot be able to recover the amount from the customer, the business will write off that amount. That is called writing off of irrecoverable debt. So first of all, I am explaining the meaning of irrecoverable debt. The debt which are not recoverable are called irrecoverable debt. Now an irrecoverable debt occurs when a trade receivable is unable to pay the amount. Suppose if in our business we have hundreds of customers, all the customers will pay the amount except a few customers, 1 or 2 customers are there, they will not pay the amount. That's a loss to the business. We will try, the businessman will try to recover the amount from each and every customer, but still after that the business may incur some loss because some of the customers may not pay the amount. So when the trade receivable is not recoverable, it is called irrecoverable debt. If a business finds that it is impossible to collect the debt, then it should be written off as irrecoverable debt. So business has to analyze all the customers. If the business feels that we cannot be able to recover our amount from Mr. X, the business will remove the name of Mr. X, will write off the debt as irrecoverable. That's a loss to the business. But that is inevitable. Because we cannot be sure that each and every customer will pay the amount. Some of the customer may not pay the amount, may become bankrupt, may become insolvent. Then the prudence concept is about being cautious when estimating expenses and losses. So there are accounting concepts like business entity concept, money measurement concept, dual aspect concept, accrual concept, etc. Similarly, one prudence concept is there. According to this prudence accounting concept, the accountant should be very cautious in recording the sales and expenses. If sales and expenses are correctly recorded, then we can ascertain the correct profit. So while recording the expenses, the prudence concept says if there is some expected loss, that loss should also be provided. Don't record any expected gain but record all expected losses. That is what prudence concept says. So according to this prudence concept, the business should record the loss on account of irrecoverable debt. Now, therefore, irrecoverable debt is an actual loss. Actual loss. Hence, this loss should be transferred to the income statement. So, what is the effect of this writing off of irrecoverable debt? It's a loss. So, this loss should be taken in expenses while making income statement. And this loss should be deducted from trade receivables in the statement of financial position. Next, allowance for irrecoverable debt. See, the actual debt is the irrecoverable debt, whereas the irrecoverable debt is called allowance for irrecoverable debt. Not only actual loss, but expected loss should also be recorded. So business will estimate how much percentage we may not be able to recover from the trade receivable. This is the expected loss, not actual loss. If the business is sure that we will not receive $500 from Mr. X, we will not be able to recover. Write off 500 rupees due from Mr. X. But at the time of closing the accounts, the business has to estimate how many dollars we may lose on account of irrecoverable debt. Expected. So that expected loss is called allowance for irrecoverable debt. If a business is likely to have some irrecoverable debt, the auditor may ask the business to have an allowance for these debts. If the business feels, the auditor says to provide some expected loss on account of irrecoverable debt. Example, a business is having totally 1 lakh or suppose 100,000. A business is having 100,000 of account receivable, trade receivable. The business has to receive the amount from so many customers. The total of all the customers due is called trade receivable. The total amount receivable is 100,000. Now business will expect that 5% we may not receive. According to experience, 5% of the total amount due we may not receive. So 100,000 into 5%, you will get 5,000. So out of 100,000, 5,000 the business is expecting that we may not receive the amount. That is called allowance. So apart from actual irrecoverable debt, allowance for irrecoverable debt should also be provided by the business. If the business thinks that we may not be able to recover the amount. To make an allowance for irrecoverable debt, a business may consider the following. So how to find out the allowance for irrecoverable debt? Two methods are there. The first method, the business has to analyze each and every customer and find out, can we be able to recover the amount from this customer A, this customer B, this customer C. So many customers are there. Every account we will analyze and find out. If we see that Mr. X is not paying the amount since last 6 to 8 months, we will try to recover. We will find out why he is not paying. If we still think that we will not be able to recover, we will put it under allowance for irrecoverable debt. We may receive or we may not receive. So analyzing the account receivable ledger, analyzing each and every account, we will find out whether we can be able to receive or not. Second method is estimating on the basis of past experience what percentage of debt will be irrecoverable. According to our past experience, previous years, we calculate what is the percentage of irrecoverable debt on trade receivable. On trade receivable. Example, last year trade receivable was 100,000 and last year irrecoverable debt was 5,000. So last year or year before last year, we have seen the trade receivable and irrecoverable debt. Last year trade receivable were 100,000 and irrecoverable debt are 5,000. So it comes to 5%. It comes to 5%. The business will make it a rule that in our business 5% of trade receivable may become irrecoverable, may not be received. So according to past experience, we calculate the percentage of irrecoverable debt. So these two methods are there of finding out the allowance for irrecoverable debt. Now points to be remembered. So for irrecoverable debt, some points you have to remember, keep in mind while solving the problem, it is necessary. Trade receivables who will definitely not pay their debts are written off and are recorded in the income statement under expenses. The trade debt means the business, the amount which is due from customers, credit customers. The amount which is due from credit customers are called trade debt. So if a business thinks that the amount due from customer may not be received, we cannot be able to recover the amount. So business will write off the irrecoverable debt. And this irrecoverable debt will be taken under expenses in the income statement. Second point, a debt that has been written off and then recovered will be added to gross profit in income statement. Sometimes a debt was written off as irrecoverable debt. Example, $5,000 are due from Mr. X. 2 years back, we have sold the goods to Mr. X. Mr. X has not paid since last 2 years. Now the business thinks that we cannot be able to recover. He will not pay, or he was died, or he was absconding, he was not available. The business will write off. Business will remove that person's name, irrecoverable debt. Later on, after a period of time, Mr. X comes and repay the amount. That is called irrecoverable debt recovered. Irrecoverable debt recovered. Now, if there is irrecoverable debt recovered, that will be added to gross profit in the income statement. Remember these points because this is very much important while doing the problem. So, if irrecoverable debt is recovered, it will be added to gross profit in the income statement. Next, third point is an allowance for irrecoverable debt is used just in case of credit customer unable to pay. So this allowance for irrecoverable debt will be created on only those customers who may not be able to pay. Some customers are there which are definitely will pay. Example, out of 100 customers, we expect 95 customers will definitely make the payment. Only 5% customers are there from which the amount may be suspicious or doubtful. In that case, we make the allowance for irrecoverable debt only for doubtful debts, not for all the debts. Next, an allowance for irrecoverable debt can change each year depending on the likelihood of credit customer paying their amounts. See here. A company cannot make a fixed or rigid policy regarding allowance for irrecoverable debt. Every year, the circumstances may change. Sometimes more allowance of irrecoverable debt is required. In 1 year, less allowance for irrecoverable debt is required depending on the circumstances or depending on the quality of the customers. If all the credit customers are good, we expect, suppose the business expect that all the credit customers are very good, they will pay prompt amount. So it is necessary to create less allowance. Suppose a business thinks that in a particular year there are credit customers who are not paying on time, more allowance for irrecoverable debt is required. So we cannot make a rigid policy. It will change from time to time. In some years, allowance for irrecoverable debt may be more. In other years, allowance for irrecoverable debt may decrease. Next point is, if there is increase in the allowance for irrecoverable debt, this increase will be taken under expenses in the income statement. This point is very, very important. If there is increase in the allowance for irrecoverable debt, example, last year closing will become current year's opening. Suppose current year is 2020. So at the beginning of 2020, 1st January 2020, allowance for irrecoverable debt was $1,000. $1,000 is the allowance for irrecoverable debt on 1st January 2020, beginning of the year. End of the year, 31st December 2020, the allowance for irrecoverable debt has increased to $1,500. So opening allowance for irrecoverable debt 1000, closing allowance for irrecoverable debt 1500. That means allowance have increased by 500. That 500 will be added in expenses. That will be taken in expenses in the income statement. So one rule, if the allowance for irrecoverable debt increased at the end of the year, so how the amount increased will be taken under expenses in income statement. First point. Second point, if the allowance for irrecoverable debt have decreased, then that decrease in allowance for irrecoverable debt will be added to gross profit. Will be added to gross profit. That's the second point. If there is decrease in the allowance for irrecoverable, this will be added to gross profit in the income statement. So in the coming problems, I'll explain you. We have to compare the allowance for irrecoverable debt at the beginning of the year and at the end of the year. If end of the year it is increased, so whatever amount increased, that should be taken under expenses. If the current year, end of the year, the allowance has decreased, so whatever amount decreased, that will be added to gross profit in the income statement. These points you have to remember. Now finally, I am going to explain you about the journal entries required for irrecoverable debt and allowance for irrecoverable debt. First, journal entry for writing off an irrecoverable debt. When an irrecoverable debt is to be written off, the entry will be irrecoverable debt debit and trade receivable or customer's account credit. So irrecoverable debt is a loss. So that's why irrecoverable debt should be debited. Irrecoverable debt debit. And credit should be given to trade receivable or customer's account. Anything. If in the problem trade receivables are given, we create trade receivable. If customer account name is given, customer account will be created. But debit should be given to irrecoverable debt. This is the entry for writing off of irrecoverable debt. Second, journal entry for making allowance for irrecoverable debt. Making allowance for irrecoverable debt. Entry will be income statement debit and allowance for irrecoverable debt credit. Here we should not write down this trade receivable or customer's account. For allowance we will not transfer to customer's account. So income statement debit and allowance for irrecoverable debt credit. This is the entry for making allowance for irrecoverable debt. Third one is journal entry for increasing allowance for irrecoverable debt. Just now I told you, beginning of the year $1,000 was the allowance. End of the year allowance has become $1,500. So how much increased end of the year? $500 have increased. So what is the entry for this increase of $500? Income statement debit, allowance for irrecoverable debt credit. Then last one, journal entry for decrease in the allowance for irrecoverable debt. Beginning of the year $1,500 allowance of irrecoverable debt. End of the year it has come down to $1,000. So 500 allowance have decreased. The entry will be allowance for irrecoverable debit and income statement credit. Opposite entry. If it is increased, income statement debited. If it is decreased, income statement credited. That point you have to remember. Whatever explanation I have given here, if you want the complete perfect command on this subject, watch the video not once, twice, thrice. If you watch the video 3 times, then definitely in the coming problems, whatever I have explained here, the same thing will come in problems. You can be able to understand the problem easily if you watch this theory video. Inshallah, in the next video, I'll explain you the problems on irrecoverable debt.